Good morning, everyone. It's 10 o'clock, so we will call the meeting to order. First item, or actually the second item on our agenda this morning is to approve the minutes of the meeting of the March 14th, 2019 meeting. Have a motion and a second on item 2. All in favor? Aye. All opposed? Motion carries. Item 3, we have some presentations this morning. Jason, why don't you give us a little prelude?
Okay, good morning. So this morning we just have regular updates from 2 of your fixed income managers. You'll note from the first page of the ASAP, your fixed income, which represents a target of 25%, is allocated across 5 areas: core bonds, which is the passive SSG aggregate strategy; Core Plus, which you'll be hearing from this morning, which is the Western Core Plus strategy, which has the ability to move in and out up to 20% of their portfolio in high yield, emerging market debt, bank loans, and other non-core sectors. When risk is being rewarded, they can move out on the risk spectrum, and at times like today, they can bring that risk in and look more like a core manager. Then you have the PAMCO hedge fund absolute return strategy, which represents 5%. The judgments that you buy from the city, I'm not sure if you buy them or if you just own them from the city, is included in the fixed income. And then global bonds, intended as a diversifier, providing other drivers of return other than U.S. interest rate risk, your currency and other foreign bond exposure represented by the Brandywine strategy, and that represents 7.5%. So the 2 managers today, Brandywine and WAMCO, is 15% of that 25. It's a majority of your fixed income portfolio. So with that, I'll turn it over to Greg Zavonia with Brandywine to go over their strategy and just give you an update on the firm and performance.
Thanks, Jason. I appreciate you bringing me back. It's been a couple of years, so I figured it was a good time to come back. And times are a little crazy out there in the world. It's interesting that WAMCO is a sister company of ours. Both of us are owned by Legg Mason. But so I have an update. You have it. But as we go along, please ask questions if anything comes up. But as I said, it's been 3 years or so since I spoke to you. So I wanted to give you a sort of an update on the firm and the team real quick, and then we'll talk to performance. Really, what were the drivers of that performance, and probably more importantly, how we're positioned today and why we're positioned, for the future and what our expectations are going forward. But as far as Brandywine, at the end of 2018, we managed a little bit over $72 billion in assets. About $56 billion of that's in fixed income, so the majority of that is in fixed income. The team that we have remains strong. In fact, since I was last here, which was February of 16. So in June of that year, we actually added 3 people to the team. A new portfolio manager, Anajit Serene, joined us from Wellington, and we had 2 new analysts, Dorothy Reynes and Alberto Boquin. So the team is very robust, but primarily led by the 4 portfolio managers that we have on the team. As far as Jason touched on sort of what we do, we manage global bonds, and we're opportunistic in our global bond approach. In that, the way we look at things, we're macro-driven, so we're looking at the world from sort of 30,000 feet and making our investment decisions based on that. We're value managers, so across everything, ultimately, we need to see sort of that mean reversion. We're looking to buy investments that maybe are undervalued, and in fact, we'll come back up and we'll sell them once they reach their full value. And lastly, Jason again touched on our currency management. We're active currency managers, so not only is our active currency management there to sort of protect your principal, but hopefully over time it tends to enhance returns as well. So, with performance, we can talk a little bit, and I'll probably just talk really to the most recent year performance. If we go back a little bit to 2017, let's just say 2017 was sort of that Goldilocks year where I think every asset class did well. It was when there was a lot of synchronized growth around the world. Your portfolio returned over 13%, picking up about 600 basis points of outperformance relative to the index. So it was a good year. It was a year when the dollar was very weak. The dollar has actually been in a protracted strength period, probably the longest in its sort of most recent 40-year history or so. So we saw that. So what do the central banks around the world do in that case? Well, things are good, so now it's going to be the time when we're going to start our normalization process. And you heard a lot about normalization, and a lot of that started in 2018. And really, when I talk about sort of the drivers of performance, and at this point you really only have to think about two economies, the U.S. and China. Europe has certainly rolled over, and really at this point we see Europe as more of a taker of growth than a maker of growth. So it really is going forward. And certainly over the last year, it's been the U.S. and China, and really the interplay between those two giant economies that's really driven the world economy. So really, what happened last year? So starting out 2018, things started going. Were pretty much the same as 2017, and then the U.S. started its what ultimately was 4 interest rate hikes, and along with that, they actually brought their balance sheet. The Fed balance sheet. And there's a lot about with that Fed, with the quantitative tightening, with the balance sheet coming down several hundred billion dollars, rolling that off. You throw that in with a little fiscal, the U.S., the corporate tax cuts, and what that really did was the outcome of that was dollar strength. As the U.S. really took off last year, and we saw bifurcation. The U.S. was really doing well, and the rest of the world was sort of floundering. A lot of assets were coming to the U.S. So when people were buying the U.S. dollar strengthens. Our portfolio does not have a lot in U.S. dollar, and it was the primary driver of our underperformance last year. I mean, if you look at really what drove performance, the bonds actually didn't do too bad. I mean, just under 2% of your absolute performance came from the bonds. As you know, over the last 6 months, I think the U.S. 10 years come down 80 basis points or so, from about 3.3 to 2.5, which isn't too bad. So that actually did well for us. Some of our corporates did well. Brazil did well. What hurt us in a relative sense on the bond side was the fact that we don't own Europe and we don't own Japan, and there's reasons why we don't own those. We're not going to buy. German bonds, 10-year German bonds given us 60 basis points. And that was 6 months ago. They're now yielding under 0. They're negative. It's the same with Japanese government bonds, yielding 15 basis points. I mean, that's 15 basis points. Now it's negative again. We currently have $10 trillion in sovereign debt around the world that's yielding negative interest rates. And that's not what we're playing for. Our number one primary driver of our performance should be our relative high real yields. We're looking for those countries that are giving us the high real yields. I mean, in our portfolio, the makeup that we see today, our yield to maturity is about 4.3%. The index that we're measured against is about 1.3%. So all things being equal, over the next year or so, you'll pick up 300 basis points just from the yield advantage that we have on the portfolio. So that's pretty much what's driving. As I said, on the bonds, the currency, it was pretty much last year was all the U.S. dollar. If you didn't own the U.S. dollar, you got hurt. If you see on our one attribution page, and most of these pages are pretty difficult to read, but the bottom side is all red, because on the left-hand side, it's every currency. There was no currency that was actually positive against the U.S. dollar last year. So our trades were, from a currency standpoint, you lost about 7% in currency trades there. And even on the relative side, we picked up a little bit because we didn't own Europe and Japan, but again, it was more than offset by some of our other currencies. I mean, we tend to own the periphery of Europe. We don't own Europe, so we like Sweden, and Sweden sold off last year from a currency standpoint. They're still trying to figure their way out, but we own the UK, Brexit being, what it is, we still find value in the British pound. We don't see a whole lot of value in the British gilts, but we do see currency value in the currency. And as I said, we own some Poland, and then we own a good bit through Southeast Asia. But I'll talk to that a little bit. But again, last year it was all about the currency and the U.S. dollar, and we think the U.S. dollar continues to be sort of long in the tooth in the strength that we've seen over the last 7 or so years. And that's really been, and you'll see that reflected in your longer term performance. You're really over the last, since inception of since we started managing money for you guys, it's really been the headwind of the U.S. dollar. U.S. dollar strength has been very strong. In fact, it remains the most overvalued currency in our universe. So again, why we tend to have an underweight position to the U.S. dollar. The next couple of pages sort of just talk to really where our portfolio is structured. The page I'll have you turn to is page 8, and that really just talks to how we're currently positioned and maybe why. So if you really think about it in a thematic standpoint, we think the world is going to do okay. And you'll see this position. We're underweight the U.S. dollar. We tend to be overweight sort of emerging market, both currencies and their debt. But the duration that we see, where the real risk we're taking on in our bonds has been in the U.S. and Mexico, are really where they're longer dated. The U.S. has done well. In fact, this year we've actually added 2 years of duration to our U.S. Treasuries, and we've benefited from that. U.S. Treasuries right now, trading about 2.5. But as I said, when we started sort of building this position, it was up over 3. So we've actually seen some pretty good valuation changes with the U.S. Treasuries, and certainly relative, as I said. I mean, 2.5 might not be too exciting as far as yield to maturity, but with both Europe and Japan trading in negative territories, all of a sudden it seems to be, wow, maybe there is some value in U.S. Treasuries, and so we maintain that. We also maintain Mexican bonos. Mexico is our largest position that we own, a little bit over 13%, yield of over 8%. So we maintain those positions. Some newer positions, at the top, as I say, these are unhedged positions. So this is where we own the bonds and the currencies. So we like both. Brazil, Colombia is a new one. Indonesia, Poland. The second piece is where mostly hedged. So the U.S. dollar, we have about 50% of the portfolio in U.S. investments, both corporate and U.S. Treasuries. But if you'll see, we've hedged out most of that exposure. So we only have about 10% in U.S. dollar. But where does that go? If you look down the bottom, there's a lot of incremental pieces where we don't like the bonds because the bonds aren't yielding anything. But there is some value in the currency, again, relative to other currencies and certainly relative to the U.S. So you see the Japanese yen, British pound, and then it said Sweden, Norway. And there's actually, over the last, in this quarter, we actually added a little bit of the Russian ruble. I mean, there's been times when we've been in the ruble in the past, but the valuations have come around. That tends to be more opportunistic. We tend not to be a long-term holding of the ruble, but again, relative, undervalued by about 18% or so relative to the U.S. dollar. So there's going to be times when we're going to have that, and as soon as something happens, and it could be either way. I mean, you position the portfolio because we don't know how, if increased sanctions from the U.S. on Russia, that more than likely will have a drag, then we might exit the position. But right now, all things being equal, there's some value to be had there. So that's really how we're positioned. We tend to underweight U.S. dollar, overweight sort of the emerging world, again, because we're finding value in the emerging world. Interesting note, everybody gets somewhat concerned about the sort of the risk. People think they're taking a lot of risk by going with into the emerging markets. 25 years ago, emerging market, there's only 2% of the emerging markets were what we would consider to be investment grade portfolio. Fast forward 25 years to 2018, and 75% of all what are considered to be emerging markets are now investment grade. I mean, we have investments in Colombia, and who 25 years ago, who would have thought Colombia would have been an investment grade investment grade portfolio. So the last piece, and I'll touch on this, and I wanted to throw, and I tend not to throw a whole lot of charts in there, but really this speaks to how the portfolio is positioned and really what our thinking is. So the first one is really the U.S. isn't an economic island. If you take a look at the blue line there, and that's really just sort of the year-over-year leading economic indicators. The U.S. last year is sort of just floating along, but what you saw with the global, so the ex-U.S., it really fell off last year. And really all we're looking for, and again, we don't need huge changes, you don't need a huge reversal, and really our big theme for this year thematically is trading spaces. So last year, the U.S. was very strong, and everything else was sort of falling off. So our thinking this year is that if we trade places, the U.S., we've seen this, has started to roll over somewhat, and you've seen stabilization outside of the United States. And that's really all you need to see for performance to really pick up. So our expectations are that these lines will begin to converge. And then the last piece that I have is sort of U.S. dollar strength. And again, we talk about this, and last year, you saw for years and years and years they were sort of moving along the line, and that's really the blue line is the U.S. versus the G10, which is some of the largest economies in the world, and the red is the U.S. versus the emerging market, and we saw some really divergence between them back in 15. Then when they started coming back together, then last year we saw that again, that big separation. The U.S. did all right against the G10, but really strengthened against some of these emerging economies. So, again, we don't need anything miraculous to happen on the emerging markets. You just need things not to be bad, and that's our expectations for that is sort of the U.S. to roll over, and once the U.S. rolls over and the growth sort of slows down, then assets start to seek those parts of the world that are growing at a faster rate, and that's how we're positioned with the portfolio. So, with that, our portfolio is positioned. We like the way we're positioned, going forward. I don't have any questions.
I have a question.
Sure.
It's kind of a general question. In your opinion, has the grading of bonds changed over the last couple of decades? I mean, was a triple B rated bond 20 years ago about the same as a triple B rated bond today?
Yeah, I mean, from a valuation standpoint, you would hope, it would be. I mean, 2008, everything got called into question with S&P and Moody's with some of the questioning of the mortgages. But yeah, our thinking, hasn't changed on that. It's relative vis-a-vis. No, the grading hasn't changed. But you're saying, I mean, no. No, I see what you're saying. No, our thinking is no. They have lightened up so that it allows, what used to be a double B to be a triple B. No, I mean, the accounting standards, if not anything, have gotten stricter. So, so we're more comfortable. Though while China's opening up, we're still not there yet. China or India, regardless of what the rating agencies say. But no, I don't think it's changed. Yeah.
Any other questions? Thank you very much.
Thank you. Performance has been good so far this year. Let's keep it up.
That's right.
Ready to
keep rolling. Rolling. Keep them doggies rolling. Okay, they all end up with me.
Okay, well, good morning, everybody.
Good morning.
Good morning. My name's Kevin Gore. I'm your Client Relationship Manager at Western Asset Management. I'd just like to thank you very much for inviting us over here to update you on our strategy and what we see going forward. I'm just going to go through a reminder of the firm, talk about how we manage your money, and then I'll hand it over to James, who's our product specialist, and he'll give you an update on the portfolio. How does that sound? Okay,
Sounds
great. So if we just turn to page 4 in the presentation, this is really a good page because it just highlights how we're set up as an asset manager. We're a global asset manager. We have 7 investment teams on the ground throughout the world, which we feel gives us a good advantage in terms of finding opportunities to manage. The other side in terms of Western Asset that I think is really good is that we have a deep investment team. We have about 129 investment professionals, and their job is to identify opportunities to put your money to work. If we then go to, a good mention here in terms of a firm update is a Zurich office. We opened that in February of this year. Main reason is for marketing, to have a presence in Europe. The second reason is obviously with the situation in Europe in terms of Brexit, it's good to have an additional foothold in the European market at the moment. But that's a good opportunity to let you know what's happening in terms of the firm. If we then go to page 7, I just feel this is a good page to let you know what's going on at the firm. One of the main business updates is the promotion. If you look halfway down on the left-hand side, promotion of Harris Trifon and Greg Hendler. They were appointed co-heads of our mortgage and consumer credit team. It was previously Anoop Agarwal. He'd been there for 5 years, but he attained a position on the East Coast as CIO, so we were able to internally promote these 2 gentlemen. This is important for you guys because consumer credit and mortgages do make up a decent part of your portfolio, so I just wanted to bring your attention to that. On the other side, just really on the notable communications, I know as a board it's important to ongoing education and stay familiar with the market, so just wanted to let you know that we have a lot of good relevant information on our website in terms of the overall market, in terms of how the Fed's thinking, so that's a good reference point if you are so inclined to find out more about fixed income. I just wanted to mention that. If we then go to page 9, just touch on this briefly. This is our investment philosophy, really how we manage your money. You have a core plus strategy with us. Really it comes down to 2 things that identify Western Asset. We take a long-term fundamental view of the market, so we're not looking for short-term gains. We have a belief that securities, perception of interest rates are mispriced, and using our deep research team that I mentioned earlier, we believe we can identify those mispricings, and the bigger the mispricing between what the market says and what we believe is how much we'll make in terms of an investment. I just wanted to mention that long-term element. The second part is the importance of diversification, and I think we all know Investment 101 says it's important to be diversified. James will talk about the different strategies that we have in a moment, but I would also like to say that our diversification, we feel that we're very good in our ability to do this because we have the people and the resources across the investment spectrum to have a good diversified portfolio. So I just wanted to mention that in terms of how we invest your money. And then finally, I'll look at performance, which is on page 15. So James today is going to talk about the year, over the last year, which has been relatively flat. This quarter, we've seen a nice bounce back in the first quarter of the year. I think really, building on that long-term fundamental value that we talk about is the performance over the longer term. We've had the relationship for over 16 years. We're very appreciative of the relationship that we have, and we feel that in terms of the long-term performance, we have done a decent job in looking to deliver on what we said we would. So with the performance mentioned, I'm going to hand it over to James now, and he's going to give you more insight over the last year and then what we see going forward. Thank you very much.
All right, good morning. Again, my name is James. I am one of the product specialists that cover multiple strategies at Western Asset, but the strategy we manage for you is a core plus type of mandate. So the benchmark you've given us is a very broad fixed income benchmark. It's an investment grade benchmark, so only investment grade bonds within the benchmark, and it's broad based. There's three main components to it. I know we've been doing this for you for a long time, so maybe you know, but the three main components are Treasuries, structured product, which is mostly mortgages, and corporate credit. So it's a diversified investment grade benchmark. Against that, over the last year, we've been kind of flat versus the benchmark. So 2018 was a very, very tough year for all risk markets, right? Anything that's non-cash, very, very tough year for all markets. There were a lot of tail risks that were priced in toward the end of the year, and we'll touch upon those in a little bit. But the way we position the portfolio, as Kevin mentioned, is we are long-term investors. Right? We're not looking to flip a quick trade over the next 2 to 3 weeks or even the next 2 to 3 months. We're looking out over the long term. We take a long-term fundamental view of how the markets are. We position against that. We put in a lot of diversified strategies, as Kevin mentioned. A lot of those diversified strategies washed out last year, and you see that on page 16 there. So some things worked, some things didn't work. I'm happy to report, though, that so far this year and even into the first week and a half of April, things are working out for us again. But I'll touch upon what didn't work as well. So page 16, as you can see, our rate strategies, both from an overall duration positioning perspective as well as yield curve, was a bit of a wash last year. We're overweight interest rate exposure, meaning we thought interest rates had risen too much last year. We're of the long-term view that U.S. growth is just okay. Positive, but just okay. And if you recall, in the middle of last year, growth accelerated a little bit, went above 3%. And the markets took that view and they just extrapolated that and said, hey, we're going to get that forever, right? Tax reform, everything's great. That's going to continue. So we kind of looked past that. There was a little bit of fiscal stimulus that affected the markets last year. That's beginning to fade now. So we thought, growth isn't that good. Inflation's not going to take off, which means rates got ahead of themselves. So we were overweight duration. That helped as the markets turned toward the end of the year and into this year, where they figured, growth isn't that great, there is no inflation, and the Fed changed their story. Right? So the duration helped. From a curve perspective, you'll see later on that where on the interest rate curve we were overweight or underweight, that didn't work out for us. This serves as a hedge for the overall portfolio, but our overall we're balanced, but we were underweight a specific part of the curve that did very well, the 10-year part of the curve. So as interest rates moved down toward the end of last year and into this year, there are some technical effects going on. I won't get into that here, but between like mortgage servicer hedging and other convexity things, that negatively affected the portfolio. So the curve positioning was a wash. Against that, we have multiple spread sector exposure, right? Multiple diversified strategies. A lot of things went in our favor. The one negative you see there is emerging market debt. So we're overweight emerging market debt in your portfolio relative to the benchmark. We've got about 4% more in your portfolio versus the benchmark. That sector got beaten up last year. There were some idiosyncratic issues, like some country-specific issues, along with growth divergence between the U.S. and the rest of the world, as well as if the Fed was going to continue to hike rates, that's not good for emerging markets as well. Those things are all turning. They've recovered a lot, but they haven't recovered everything just yet. I'm going to pause there and see if there's any questions. All right, let's take a look at the portfolio then. It's on page 17, and you'll see why certain things were beneficial. From a portfolio perspective, we are underweight the Treasury component of your benchmark, That's the very kind of top line on the upper left-hand side there. And we use that to allocate to positions what we would call spread sectors. So mortgages or structured credit or consumer credit, as Kevin mentioned. That's the kind of the middle there. CMBS would be commercial mortgage-backed securities. Right? You can see we're overweight, 4.6% in your portfolio versus 2% of the benchmark. We think that's attractive. Non-agency MBS, so non-agency mortgages. Those would be private mortgages not issued by the government agencies. These are legacy positions from 10, 12 years ago, from the crisis days. Back then, they were called toxic. Now they're called legacy positions because they don't make them anymore. You can't get your hands on these, right? If you sell them, they're gone. But they're performing great nowadays, right? Home prices have risen. Things are fine 10 to 12 years after the crisis. We are overweight investment-grade credit. There's a little bit of a green bar that sticks out right there. We've taken that overweight temporarily through a derivative contract. So that's what the little green bar mentions. Because why are we using derivatives? Yeah, because liquidity is kind of challenged in the markets these days, right? We're down a couple of banks post-crisis. There is no more Lehman, no more Bear. And those banks that are left out there have a much smaller balance sheet with which to support trading. So if we want to take this is more of an opportunistic trade for us here. Credit spreads and all risk asset spreads widened last year, meaning they got cheaper and cheaper. Right? People toward the end of the year started pricing in a recession this year, mainly because they thought the Fed was just going to be intransient and keep hiking and kill the recovery. So because of that, spreads widened. We kind of thought the Fed would change their mind, which fortunately they did. And so we added to this position, but this is the quickest, easiest, most liquid way to add that position. Right? If you were to transact in physical cash bonds, we'd do that if we had a real long-term view. Things would be okay. But this is the cheapest way to do so. You pay the least in transaction costs, and you can put it on and take it off very quickly. It's just that it's not like stocks where it trades on the board, right? In bond world, you still mostly have to pick up the phone and call somebody and transact that way. And toward the end of the year, banks are shutting down their balance sheet, but things were leaking wider and wider. So this was an efficient way to add extra exposure. Does that answer your question? Great. And then apart from that, you see at the very bottom there the various emerging market sectors. So either it's governments, local currencies, or corporates. We have more exposure there than your benchmark. That didn't work out in 2018, but we think longer term, it's a great place to be. It's actually, we think, the most attractive area to be. So while it's not the largest sector overweight versus your benchmark within what you see on page 17, it actually does contribute the most risk because this sector does bounce around the most. But currently, we think it does offer the most value. Correct.
So relative to the last 10 years, that plus sector allocation is fairly low. Correct?
It is, relative to the last 10 years, it is fairly low because 10 years ago, everything was so cheap after the crisis.
So I just want to make sure everybody understands your ability to move that up and down, those non-core sectors.
Correct. Correct. So we think things are okay now. It's not like 2009 where everything was on sale. Right? We get it. We're 10 years past the crisis, 10 years into the cycle right now. So we're taking, don't get me wrong, we still have risk positions away from your benchmark. They're just, as Jason mentioned, more muted versus where they were in the past. So with that, and in the interest of time, let's hop to the outlook, unless there's any questions on the portfolio. No? All right, let's take a look at the outlook section. That begins on page 20. So it starts with a very brief recap of what happened in 2018. And as I mentioned, it was a tough year. At the beginning of 2018, the market consensus out there was for global synchronized growth, right? If you have younger kids like I do, they watch a Lego movie, everything is awesome at the beginning of 2018. That didn't turn out to be the case. You see, cash did well, and these are all the other spread sectors out there, whether it's emerging market debt, or U.S. high yield, or U.S. investment grade credit, or even mortgages. Everything underperformed a Treasury bond last year. Spreads widened. A lot of risk was priced in. What happened? Right? Well, one, on page 21, you can see global growth started to diverge in the beginning of 2018. So again, what the market does is it takes recent history and it always extrapolates that. Right? 2017 was great. You see, this is the economic surprise index on page 21, whether the economic data points come out better or worse than what people were thinking. And throughout 2017, it kept coming out better. And so they thought that growth would continue. U.S. growth was okay, right? Continued to accelerate into the summer, and then it kind of went sideways. But almost immediately, Europe and the emerging markets started to disappoint. So that's one reason. But the biggest fear out there, at least for credit markets, and it does spill over into your other asset classes as well, is the confusing communication from the Fed last year. So if you follow the markets, on page 22, we put out a bunch of quotes, but the real kicker came in October, where the new Fed chairman, Jerome Powell, said, we're a long way from neutral. Right? They had already hiked 3 times last year. Markets kind of predicted they were going to hike the 4th time in December, and then they were probably going to take a pause. But when he said we're a long way from neutral, that meant he wanted to hike even more. And so I forget the name of the MIT economist who said this, but he said, business cycles don't die of old age. They always die because they were murdered by the Fed. Right? And the old Fed chairman, Bernanke, actually used that at a January meeting as well. He mentioned that as well, too. But it was, if you look in the next page, on page 23, right, what we're highlighting here is the new talking points from Chairman Powell there. And it was actually at this January 3rd meeting at Atlanta where he and the 2 former Fed chairmen were giving speeches concurrently. Right? I think they probably just pulled him aside. I'm sure that he knew even ahead of that he was already spooking the markets. But I'm sure they pulled him aside and said, you know, hey, be consistent in how you speak to the markets, right? Don't spook the markets. So the Fed right now has one talking point: patience. Patience, patience, patience. Right? They're going to wait and see what's going on. So right now the market's not pricing in any hikes this year. If anything, there's a small probability that we might actually get a cut toward the end of the year. But as recently as 3 months ago, they were pricing in 2 more hikes this year, right? Tightening of monetary conditions, right? Making credit that much more expensive and choking off the economy. But that's all changed now. So that was the big tail risk that was coming into the market at the end of last year that spooked the market. That is off the table now. And that's why risk assets and the various spread sectors that we've allocated to have outperformed this year. And then you see that on page 24. Just look at the table on the far right-hand side there. This is a table of excess returns. So how have spread sectors performed relative to a comparable maturity Treasury bond? If it's in red, that means they underperform. So it's a risk-off year. And you can see 2018, a risk-off year, right? It's almost red up and down the whole column. And so far in 2019, everything's rebounded. So with that, I'll give you our kind of our outlook for 2019 and beyond. Again, thank you for allowing us to speak to you guys this year. If we were here last year, the bullet points on page 25 wouldn't look all that different. As I mentioned earlier, we are long-term, fundamental value investors. We combine those 3 things. We take a long-term fundamental view of the world, and then we compare that with valuations, with where bonds are trading. And our long-term view is basically the same. Global growth is downshifted, but positive, still positive. We do not foresee a recession this year. Crystal ball doesn't go that far out, but we don't see signs. We don't see excesses that have been built up in the market that need, bubbles that need to be popped. So we don't see a recession. We don't see inflation taking off either. There are too many disinflationary factors out there, too many things holding back inflation. So if growth doesn't take off and inflation doesn't take off, that means the Fed doesn't need to move and interest rates kind of go sideways from here. Right. Central bank policy should be accommodative. Trade policy, that fourth bullet point, that is a big risk. This game of chicken that we're playing with China, that's a big risk. We'll see how that goes. It's turning better. Right? We're seeing progress there, but that is still a risk because that could obviously sink the global economy if it doesn't go well. But with that backdrop, that leads to our last two bullet points on the page, that spread products should recover and should outperform Treasury bonds. That's why we're overweight so many spread sectors, whether it's consumer credit or emerging markets or corporate bonds. Right? In this environment where growth is slow, interest rates move sideways, the Fed is on hold, that means everything goes sideways. So a corporate bond with more spread, more carry, more yield than a Treasury bond should outperform over the year because everything's just going sideways. And within the spread sectors, emerging markets are the cheapest. They have the most risk, but they're the cheapest. But we have a measured allocation to them right now. So about 4% more in the portfolio versus your benchmark. All right. If there are no questions there, I can touch upon a couple of the other market slides that we think reinforces our view. So on page 26 there, you see here's a snapshot of global growth, sideways. Actually, the IMF, International Monetary Fund, just came out with their estimates. So this is the third time they've downgraded global growth in the last 6 months. They've downgraded it to about 3.3%. The U.S. is probably growing at about 2%. Europe, 0 to 1%. What you have is Asia and China kind of picking up the slack there. Right? But still, very muted, tempered growth. Inflation, as you can see on the upper right-hand chart, very low and sideways. And kind of what keeps these two things low is what we have on the bottom there. What keeps inflation low, right? The 3 Ds, debt, demographics, and disruption. Disruption, I would say, is technology, or you can call it the Amazon effect, right? Just price transparency. Everything's just getting more efficient. But from a debt perspective, you can see debt levels are already high everywhere, right? Everybody's already borrowed. We've already spent the future. So that's all debt is. It's just future consumption pulled forward. So we've already spent, which means it'd be harder for us to spend more to ramp up growth near term. Right? We've already borrowed from the future. Demographics, on page 26, this is tough. All of the developed world is just getting older, less workers. How do you get growth? Growing workforce or better productivity? We don't have the growing workforce. None of the developed world does. And China, which has powered the world for the past 20 years, demographically, they are where Japan was back in 1990. So China, right, they always had the fight to get rich before they got old. Well, now they're old. And then the last thing, anecdotally, is the disruption effect, right, the Amazon effect. So those three things serve to hold back growth and inflation. Are there any questions?
There was a question to the last panelist about credit ratings and rating agencies and relaxed standards.
Yes.
We have a couple slides in here.
We do.
Not necessarily looking at it from a credit rating agency, rating standards, but just the proliferation of triple B.
Mm-hmm. Sure. So that is the topic du jour in the credit markets right now, the deterioration in the credit quality of corporate bond issuers, particularly in the U.S. So turn with me to page 31. So triple Bs are the lowest rated investment grade rating you can get. Right? Once you're in double B, you're in high yield world or junk bond world, back in the old days. But as you can see on page 31, triple Bs as a percentage of the credit universe has ballooned over the last 10 years. And this has been ongoing. This has been ongoing for the last, call it, 30 to 40 years. Right? 40 years ago, you had a lot of AAA companies. Now you only have a handful. There's not that many AA's left. So the credit universe is between single A's and triple B's. About 80% of all corporate bonds is either single A or triple B. The problem is single A companies figured, I don't need to maintain a single A balance sheet anymore. Right? I'm going to borrow more money and pay it back to my shareholders. Stock buybacks, dividend repurchase, go buy another company. That levers up the balance sheet, taking on more debt. They've kind of figured they can do that because it's okay. All-in interest rates have come down over the last 10 years. Right? You pay a little bit more if you have a triple B balance sheet versus a single A balance sheet, but all-in yields are so low, it was easy for them to do so. So, I mean, the easy example would be like Union Pacific, right? Largest railroad company in the U.S. They were single A last year, announced a $20 billion stock buyback, immediately borrowed $6 billion from the bond markets, immediately got downgraded to triple B. The CFO's like, that's okay. So that's the concern, the biggest concern in our marketplace today is the rise of triple Bs. But you scratch beneath the surface and you see where has the growth in triple Bs come from? It's a little bit less concerning. So over the last 10 years, you can see that the growth in triple Bs has come in three main industries: banks, healthcare and pharma, and autos. They've kind of got there in the three different ways. Right? Banks obviously were downgraded post-crisis. All of them were downgraded. It's a different story in banks now. Banks' balance sheets are as strong as they've ever been. Right? The regulators have been in control of the banking industry for the past 10 years. They have way more capital on their balance sheets. They have much better loans. They're much safer institutions than they were 10 years ago. So we're not so concerned about banks. Banks are actually going in the other direction. They're getting upgraded. Citigroup, for example, just got upgraded back in February from triple B to single A. So about 1% of this 5% increase is gone now, just reversed 2 months ago. They're all being upgraded, right? They're making record profits. It's probably an issue for some folks that they're making record profits, but banks are fine. Healthcare and pharma, this is an area that our analysts saw coming 20 years ago. They all knew that these firms had single A, double A balance sheets back then, but their drug pipeline wasn't that strong. So how do you sustain earnings growth? You go buy your competitor. So we've seen a lot of that happening. But healthcare and pharma is a non-cyclical industry, meaning if the cycle turns and there's a recession, people still need to buy Medicare, medical care and drugs and stuff like that. Right? It's not a pro-cyclical industry where people are going to cut back expenditures on. And these companies all kind of want to hold the line when they get to this triple B level. Because, as I said, if you go from a single A bond to a triple B bond, you pay maybe about an extra 0.5% in interest. That's okay. They can do that. If you drop from triple B to junk, you pay an extra 150 basis points, an extra 1.5%. Right? That becomes painful to them. So they all kind of hold the line once they get to triple B. And then the last sector where we saw growth in triple Bs was autos, but that actually came the other way because if you recall, Ford and GM used to be triple A companies 20 years ago. Right? Then they went all the way to junk. Some of them defaulted, and then they clawed their way back to triple B. So they came from the bottom up. So we are actually concerned about Ford, less concerned about GM, but we think Ford is at risk of being downgraded back to junk. So that is an area that we're concerned about. But this is the main concern in the market right now. If we have time, let me turn to one more page, then the next page, page 32. Right? Don't worry, I'm not going to go over every one of these companies in detail. But what we did was we took a look at the 30 largest triple B companies out there. Let's just look at the top 5 out here. AT&T, Verizon, CVS, Anheuser-Busch, General Electric. Yes, they're BBB rated. They all got there on purpose. And we think none of these, well, not none of these, but very, very few of these firms are at risk of being downgraded to below investment grade. These are mega cap companies. They have a lot of levers to pull. They have divisions they can sell to take down debt. They can cut CapEx, or the worst thing they could do for equity holders at least is to cut the dividend. They don't want to, but that is something they can do. But you look at AT&T, a 6.5% dividend. If they had to defend their balance sheet, they could do it. Anheuser-Busch just cut their dividend because they had bad earnings. So we get it. A lot of eyeballs on this BBB world, but we think we have a lot of eyeballs on it too. So I'm going to pause there and see if there are any questions. No? Well, then, with that said, I'll just sum up. As I said, we think growth is okay, inflation's low. It's a benign environment, at least for the short term. So we are overweight spread product versus your benchmark, and we think it's going to be a good year for carry. Okay.
So thank you very much again for the relationship. We really do appreciate the business and the opportunity to update you today on the strategy. Do you have any further questions for me on the business?
Any questions? Thank you very much.
Yeah, no, thank you. Thank you.
Item number 4 on the agenda is the consent docket. We have one item. I have a motion and a second on item 4A. All in favor? All opposed? Motion carries. Item 5 is to ratify approvals. We have 3 items. I have a motion and a second on item 5. All in favor? All opposed? Motion carries. Item 6 is to approve the claims docket. I have a motion and a second on item 6. All in favor? Aye. All opposed? Motion carries. Item 7 is to approve the following applications for service retirement. We have several. I have a motion and a second on item 7. All in favor? All opposed? Motion carries. Item 8 is to receive the report of death, authorize payment of the $5,000 death benefit, and authorize the Secretary to make necessary changes to conform on the following. I have a motion and a second on item 8. All in favor? Aye. All opposed? Motion carries. Item 9 is to receive the report of death, authorize payment of the $5,000 death benefit, and approve continuation of the pension to the spouse. I have a motion and a second on item 10. On item 9. All in favor? Aye. All opposed? Motion carries. Item 10 is to receive the report of death, authorize Secretary to make necessary changes to conform on the following. Motion and a second on item 10. All in favor? All opposed? Motion carries. Item 11, approve the request of the following to terminate vested rights and commence drawing benefits. Have a motion and a second on item 11. All in favor? All opposed? Motion carries. Item 12 is investment consultant report.
Okay, good morning again. So you all should have the ASAP in front of you. Just a couple more comments on the fixed income managers that you saw today, and you'll note on the first page of the ASAP, within the fixed income allocation, the target to core bonds is 5%. That's the SSGA strategy, and you are a little bit underweight that. And the target to core plus is 7.5. I think it's important, and one of the reasons why I asked the question about how Western is currently allocated, that strategy has brought down the risk So it's mostly core at this point, so we're not uncomfortable with that overweight to Western versus SSGA, because it's really, you still have majority of your, that 15 or that 12.5% in core bonds, if you will. Although we'll keep an eye on that, because the range, the low end of the range for SSGA is 2.5%. Hopefully you got an understanding of the difference between those two. The Brandywine strategy will be the most differentiated and providing the most diversification relative to the other bonds. It's not going to behave like your traditional bond strategies. You'll have years like 2017 where they're up 13%, and then years like 2018 where they're down 5%. So it's behaving very differently, but hopefully you got the sense from both of them. What they're really doing is trying to seek out higher real yields, so higher coupon payments by allocating across different markets. And so over the long term, that has proven to be beneficial. The one-year return of your overall fixed income composite, as you look at on the ASAP, underperforming the ag, and that's primarily been from that currency impact in the Brandywine portfolio. That was a headwind over the trailing 1 year, but you're starting to see year to date, as those risk assets have bounced back relative to Treasuries, overall, not just within fixed income, but the overall portfolio has done well. But within the fixed income alone, the fixed income is up a little over 3% year to date, where the benchmark Barclays Ag is up 2.9%, and a lot of that has come from the Brandywine strategy up 3.2%, WAMCO up 3.78%, so getting a big bounce back there. Year to date, the things that were down the most last year are up the most so far this year. So small cap down over 20% in the fourth quarter. Small cap, the best performing asset class in the first quarter. On the second page of the ASAP, you'll see that for the 3-month period, your small cap composite, so Ernest and Times Square together, up 20% versus the Russell 2000 up 15.8. Your large cap composite outperforming the S&P. Much of that coming from the Intech strategy outperforming. The 1 year number, so the 1 year return for the overall large cap, which you have two managers, an index strategy, the SSGA S&P 500 index, and Intech, which is a benchmark risk controlled strategy. It is an active strategy that through a mathematical process tries to create a portfolio that looks a lot like the benchmark, but it will overweight those stocks within the benchmark that have higher volatility. And so what that does, even within the large cap benchmark, it's going to overweight the smaller capitalized companies in the large cap benchmark. So in 2018, the smaller companies in the large cap universe did worse, down the most. And consistent with what we've seen historically, that is a difficult time for Intech. And so that 1 year return for Intech, pretty significant dispersion relative to the benchmark that's impacting the 1 year, really the 1, 3, and 5 year numbers of your overall large cap relative to the benchmark. 3, 5 years you're much closer, but that's why that 1 year number is so different. So overall, the trailing 1 year now through March up 3% gross versus the policy index 4.7. That's a pretty big dispersion. Much of that is coming from large cap and fixed income because of the currency exposure within your fixed income. So your overall fixed income up 1.4% versus the benchmark ag up 4.48. That represents 25% of your assets, and large cap 21% of your assets. So the two biggest allocations overall relative to the benchmark on a 1 year period had some negative contribution. Longer term, we're not seeing that. It's really isolated to that year, and we're seeing a nice bounce back on a year-to-date basis. 10-year number, I think last month it was a little bit better. We're now 10 years from the where the market turned after the financial crisis of 2008. March 9th was really the date considered to be the market bottom. So we're a little bit, the end of March now is past 10 years. I think last month that was up a little bit higher, but your 10-year return through the end of March is a little over 10%, so a very good 10-year period. And you've done a lot just from as a stewards of this long-term portfolio, recognizing that going forward, expected returns aren't going to be as robust. We came through a 10-year period where we were at historical lows in markets. Today, we're not at that same starting point. So what you've done, bringing your actuarial required rate of return down, certainly is, in our opinion, very sound practice. Our expectations going forward are more single-digit, mid-single-digit returns over the next 5 to 10 years for portfolios. At this point, no manager issues or concerns qualitatively or quantitatively on any of your managers. Any questions?
Any questions for Jason?
Okay, thank you.
Thank you, sir. Item number 13 is comments from board, staff, and citizens. Hearing none, we are adjourned at 11:01. Thank you.